Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And got back from lunch today, and I had spent my lunch spilling au jus sauce all over my sweater. So I'm wearing the only hooded sweatshirt that I had in my car. Now, the reason I bring this up is looking like the most homeless person in the office today. I decided to get the best looking guy in the office today to come join me for this week's recording. So Rob, welcome back.
Thank you, Miles. Good to be here.
So Rob, what kind of week have we had? It's been a little bouncy.
It's been bouncy in the markets, crazy, tons of phone calls. People are very concerned about the next steps forward for our market, and that's what we're going to talk about today.
Yeah, so let's start with the thing that everything's kind of anchoring around, and that's the U.S. dollar. So the U.S. dollar index got all the way up to 115. I think we're sitting back down now about 111. We've had about a 4-point move back down. So the U.S. dollar got up to about 115 with a move back down to 111. And with the speed that we saw the dollar rise over the last couple months, rising interest rates, as well as, let's call it, not so favorable currency conditions for places like China, Europe, and Japan, the dollar obviously is showing significant strength, at least in the short term, but what goes up must come down. And anything that's going to move that aggressively is going to see some type of retracement from time to time. So are we seeing a retracement, or are we seeing a change in trend? That we don't know quite yet, but what do we think we're seeing?
Well, the Wall Street crowd is anticipating a Fed pivot in the short term, but I think our position will be and continue to be that Chairman Powell will continue to do his actions until he breaks something, but it's breaking now.
So at 26% down this year in the U.S. equities market, nothing's broken yet? Is that what you're saying?
Not yet, but it's coming. Look what is happening to the real estate market right now. It is flatlining and dropping.
Right. So real estate's declining or beginning to decline. That's a little more recent than the equities market, but the equities market decline's only 6 months old anyway at this point. The equities market is obviously, I don't think we've hit bottom personally, but the equities market is definitely in the middle of falling off the cliff. Now we're seeing real estate begin to fall, which is expected with the interest rate rises. It becomes more difficult to borrow. What's next? Like, what other market is out there?
Well, we already know the bond market has had its troubles as well, and that's where the big money is.
Right, the bond market and the yield curve inversion rate we've talked about, where you're seeing these better rates in some of the short-term timeframes than the long-term.
Absolutely.
Which tells us that the bond market doesn't trust that Powell can continue to hold and raise interest rates for years to come.
That is correct. I mean, we're already at a $446 billion interest payment. Our national debt just crossed over $31 trillion today, and there's just no stopping. They have no choice but to print and borrow aggressively from this point forward.
We're seeing that with the continued inflation rate staying above 8%.
Right. And we're also seeing the fact that the Fed hasn't really trimmed its balance sheet to anything meaningful. So the Fed's balance sheet continues to be huge. I think the next thing to break is going to be pension funds, is my personal opinion. That's what happened in England earlier this week. That's why the Bank of England had to step in, because their pension funds were going under. I think the pensions are on the bubble. We'll see what happens.
And it's arguable that that's where most of Americans keep most of their money, outside of the home they live in or equity they've built up in the home they've lived in. Most people keep more in their pension funds, 401ks, retirement, things like that, than obviously they do just in their personal brokerage accounts. So breaking of the retirement system in this country, or a decline in the investments within that retirement system, I guess is a better way to put it, without being able to get into cash positions. A lot of people feel locked into their investments in 401ks. You get your menu of like 10 items. They're all pretty much identical. It's a burger joint, so all the burgers are the same in most 401ks. Some might have a little bit more Facebook, some might have a little bit more Amazon, but ultimately they're all the same funds. And then you're 100% invested, and a lot of people don't realize you can actually call and liquidate and sit in cash for periods of time, but I don't think most people do that. And as the equities market's declining, We're seeing a large population that's already down 20+% in their retirement.
For the last few years, they've been letting it ride. Why not? The equities market treated them very well. But talk about a pivot. It has definitely changed in the last 6 months. And there's a lot of people sitting on retirement funds from companies that they did retire from and don't even realize that they can access those funds, roll them into an IRA, and have more control as to where their money is.
Sure. I mean, the Dow's still around 30,000. That feels pretty good, doesn't it?
Yeah.
Compared to where we were after the last great fall, down around 6,600 up to 30,000. Who cares if it was 34,000 at one point, right?
Right. And their brokers are saying, well, just write it out. It'll always come back. It always does. Until it doesn't.
Yeah, we looked at that a couple weeks ago. We looked at, say, all the markets against each other over the last 20 years. And Dow's doing pretty well. It's up like 280% in the last 20 years, which is a little bit more than half of what gold has done in 20 years, which is kind of terrifying when you think about the dead relic gold being up over 400%.
Exactly.
And the investment assets being up less than 300. That's something to keep in mind long term. But so speaking of gold, with the dollar turning down, which is completely reasonable, the dollar's been on a tear. And we think that's important. It's important to remember that things do have to cool off from time to time. And perhaps we're seeing the dollar cool off. And as long as Powell can continue to raise interest rates, that's definitely the case.
Yep.
We're just in a cool off. We might not be, but we definitely are thus far. Everything else except for the Japanese yen, unfortunately, but Japan's had a rough week. But everything else, the euro, the pound, and especially things like gold and silver have bounced pretty strong against the dollar with the dollar decline this week.
Yeah, we've had a $100 bounce in the price of gold in a week. That's gotten some people's attention.
So the two numbers I care the most about in gold, if we are going to continue on the way up, are 1855 and 1915. And I'll draw this on the chart here. Part of it has to do with some RSI divergence that we're seeing. We did have some repeating declining bottoms with some indicators having rising bottoms, as you can see on the chart here. And that usually indicates at least a short-term break, a divergence from the trend.
Well, and how do you feel about, is it the 382 fib at 1675? We are now in the 1720 range. How do you feel about that as being a floor again? Do you think it'll hold if it retraces?
In the short term, yeah. I think we definitely could see some of these shorter term fib levels be floors on the way up to more of a medium term decline.
Yep.
When you're talking about the decline we've had, say, since August, coming from around 1800 all the way down into the 1600s. But if you stretch that back a little bit and we go back to, say, the high previously this year. We had the Ukraine invasion high back in March, and then you had the start of the decline back in around April from around 2000 all the way down to in the 1600s. So your 382 fib on that longer timeline is actually pretty close to where we're at now at around 1762. So I think we're definitely going to see that pricing up. So that's up another $50 from where we're at now. And then again, your 618 up around 1855. And I'd like to see us push up to that high. So I would argue that you can't really say bull market until we're stepping above these prices.
Yes, I agree.
And that feels like a long way from here.
But it's not.
I mean, we're talking a $400 trading range over the last 2 years.
Yeah.
So $200 feels like a lot more than it actually is when you look at it as a percentage. I think that also tells us that when we do finally break out of this trading range, if you have a $50 trading range and you break out of it, you're going to have a $150 move one way or the other.
Right.
If you have a $400 trading range,
you have a $2,000 or $3,000.
Yeah, what kind of movement could you end up seeing?
Dramatic.
So let's bring in a little bit of Elliott Wave and one of our favorites, the sisters Pamela and Marianne Aiden, on their report, which is a great report. If you're not getting it, it's worth every penny. So Pamela and Marianne Aiden talking about their ABCD Elliott Wave theory. What are you hearing from the Aidens?
Well, they're looking at the same things we are. They're very close to the same kind of Fibonacci points that we are looking at. They are anticipating the D wave having been done, and now we are moving higher. but we still have to break above the mid-1800s and the low 1900s to show that we are in an A wave. And they didn't make a prediction of where that's going, but I think you and I agree probably in the 2500 range.
Yeah, your A wave bull market trend movement obviously has to exceed the previous movement,
Correct.
right?
Yep.
So let's ballpark a number around 2,500. B wave movement down somewhere between that and where we are now.
Mm-hmm.
The C wave's the big one. And the D wave is the big corrective crash at the end of the market move, which leads into something like we had for the last 2 years.
Yep.
So that tends to be a pretty consistent pattern. There's some human psychology that you can build into that. Initial investors, followed by a slight blow off. Then there's the manic phase, followed by the manic sell at the end. So could you see 2,500 on an A wave?
Sure.
And then realize the C wave usually extends quite a bit beyond that?
Yeah.
Where are we looking for gold to go from here, I think is the big question a lot of people are asking. And then what does the US dollar look like when that happens?
Yeah.
And your cost of living. And like you were talking about earlier, when you look at Fed spending, Fed balance sheet, and when I say Fed spending, I mean I should say U.S. government spending. Sure, they've stepped back their borrowing. They're expecting to borrow a little over $1 trillion. It was 2.4 last year. So they have stepped back their borrowing some from the end of the couple-year COVID excessive spending era that we were in. But they're still overspending, and they're overspending at interest rates multiples of what they were last year.
Correct.
So you and I might be facing the austerity of Fed raising interest rates and how that's going to affect our retirement accounts, how that's going to affect our home buying possibilities. But the Fed doesn't seem to care.
No.
U.S. government's just going to keep borrowing, whether the inflation rate is 8% or 2%. They just don't seem to care.
And when we get into 2023, halfway into 2023, now we're in the election cycle, the big election cycle.
It's a great time to spend money.
Yes.
If you're in the government.
Yes.
So with all that being said, just be aware, hear the overarching theme here. We are still in a gold bear market technically. We recognize that we're in a little divergence against that, which could be a reversal back up to the top end of the trading range. And we'll certainly be keeping an eye on that over the next couple weeks. As always, we encourage our clients, don't try to catch the falling knife. When you know what the long term is going to look like over the next number of years, the best thing you can do is get on a plan where you are protecting yourself on a regular basis, adding to your gold position on a regular basis in small increments over time, and maybe think about getting a little liquid in your equity positions.
Well, and that's where we come in, because buying gold is a little bit like buying an airplane. You can fly it on your own, or wouldn't it be handy to have a guy in the co-pilot seat? And that's what we do.
Yeah, Rob, as a guy who's been a gold pilot for about 40 years, I don't know a better one to bring in here every week. So I've certainly appreciated your wisdom through the years I've worked here and tempered opinion about market moves. So thank you. I really appreciate you joining me again this week.
Thanks for having me again.
And you out there in listener land, thank you guys for joining us again this week as well. So if you haven't talked to your gold portfolio co-pilot in a little bit, why not give us a buzz here at McIlvaney ICA? We can be reached at 800-525-9556. You can also find us on our socials, Twitter, we're ICA Gold, and Facebook, we're McIlvaney Financial, or just head on over to our website at mcilvaney.com. Thanks for listening as always, and have a great week.